So, given today's huge stock price decline for HIMS and HERS stock, I know many investors are interested in this company. And so I wanted to conduct a financial analysis here as related to what the company's management team said in their latest quarterly earnings call. And I'll share with you some longer term trend lines for the company's operating cash flow and return on investor capital to better help you understand this company as you begin to conduct more research, as you realize the big stock price decline might be an opportunity for long-term investment.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company's management team said that they undertake a rigorous capital allocation standard, inclusive of a payback period of less than 1 year on marketing investments. So that means when they're looking at spending money on advertising or other forms of marketing, they look at a payback period of 1 year. So if they spend $1,000 on advertising, they want to be able to get back that $1,000 within 1 year. Now, the payback period is one of the least uh, important, in my opinion. I teach I teach finance, international finance, corporate finance at the university level, and I teach undergraduate students and graduate students. And capital investment strategy is something that I teach in all of my finance courses. It's very important to corporate strategy, their capital investment. And you have various forms of calculating your payback or how you should allocate capital. And, I teach the net present value calculation, the internal rate of return calculation, and the payback period calculation is also included. But what I tell students is the payback period is the least important one, because how do you determine what's a good payback period, right? If you're getting your money back in 2 years, is that good or is that bad? If you're getting your money back in 5 years, is that good or is that bad? I don't know. It depends on the situation. It depends on the individual. What I look at as more important is the net present value calculation, which incorporates the discount rate, it incorporates the risk, but it also incorporates more than just getting your money back. It incorporates the longer term positive value from that investment. That's what I prefer corporate managers look at when making capital investment decisions, not the payback period. So when seeing this, I thought, okay, it's nice to hear them talk about, having a rigorous capital allocation strategy and a payback period of less than 1 year, because uh, HIMS and HERS, as a percentage of revenue, they spend a large percentage on marketing. And so I think that's why the company's management team made it a point here to say that they look for a payback period of less than 1 year, because on the flip side, they know that investors are concerned because they do spend a large percentage of their revenue on marketing. So they also noted that their adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, increased to $91 million, nearly triple what we delivered in the same quarter last year. Adjusted EBITDA margins expanded by over 4 points quarter over quarter to nearly 16%. Now, if you've been a follower of Warren Buffett and Charlie Munger, they criticize the EBITDA as a financial metric and adjusted EBITDA even more than EBITDA, because EBITDA in and of itself is an adjusted financial figure, right? It takes earnings before interest, taxes, depreciation, and amortization. So it's already adjusted. And then adjusting that already adjusted number is yet another adjustment. So it's just a way for the management team to highlight positive numbers instead of highlighting negative numbers if the company is not profitable on the bottom line. But it does give investors a proxy of cash flow. It does give investors an understanding of if the company is at least close to generating positive cash flow, which HIMS and HERS is, right? So let me share with you their longer term, their operating cash flow to sales ratio. is positive and well positive, 18.7% in the most recent period, and that's up from around negative 215% in 2018. So they've made great progress in turning around their cash flow. And when a business is positive in cash flow from operations, it's basically self-sustaining. It doesn't need to go back to investors and ask for more capital. It can if it finds an opportunistic way to do so, but it doesn't need to, which means it's less risky as before it was positive in cash flow from operations. So hitting that inflection point like they did from 2022, where they were still negative at 5%, and then in 2023 at 8.4%, it dramatically lowers the risk level. And then when they go from 8.4% to 18.7%, and they demonstrate 3 straight years of positive cash flow from operations, it again points to another positive, another risk reduction for investors. For a growth company, especially, you feel like, okay, they can sustain themselves, they can sustain their growth, they don't need to go to investors, and so they don't expose themselves to needing to raise capital at desperate levels. So they went on to say that gross profit margins declined, but they expect improvement in the second quarter as they benefit from economies in scale. And like I mentioned, marketing spending is a large percentage of revenue at 39%, but that was an improvement of 8 points year over year. And management has said that every year they expect to be able to improve this metric by a couple of percentage points. So as a percentage of revenue, marketing will continue to decline as you reach larger scale. And advertising is a scale sensitive category. The more your revenue grows, if your advertising level stays the same or doesn't grow by as much, as a percentage of revenue, it constitutes a smaller percentage. Another way they're lowering that marketing spending is because more of their subscribers are coming to their platform through organic and other lower cost channels. And that's very positive because it means they're benefiting from positive word of mouth. People are talking about the company and people are joining the company as they hear about it from somebody else, or maybe somebody talks about it on a social media platform, or maybe during a weekend barbecue, they talk about it with their friends and family, and people join the platform in that way. And so that's another way that the company is benefiting and demonstrating a lower marketing spending as a percentage of revenue. And overall, they've been great at demonstrating strong returns on the capital they invest. So as an investor, you can be confident when Hims and Hers spends money that they're going to get back very positive results, because in the most recent 2 years, they've generated a 40% return on invested capital. And when a company is demonstrating this kind of level of return on investor capital, I'm happy to see them spend more money, because they've demonstrated to me that they know how to allocate capital. And so when they tell me that they're spending more money, I think to myself, oh, that's great, because this management team knows what they're doing. So if they're spending this money, that means they found an opportunity. So I should be happy with that money spent. And that's what I see with Hims and Hers. I can't say that for every company I'm following, but I can say that with Hims and Hers because of the very strong ROIC to sales number and the improving OCF to sales number. So that's what I wanted to talk about in this short video, just provide an overview and some financial analysis for Hims and Hers stock. And if you're thinking about buying or selling this stock following that big 34% decline on Monday, I would recommend you do more due diligence before making a decision. I've got a lot of videos. I'll link to some of them at the end of this one so you can further do your due diligence before making a decision. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.